Well, hello everybody, and we're going to start off today with a big gain in the market. At least on the Nasdaq side, we are back to where we left off, pretty close to the getting out of the bear. Today, we're actually going to talk about some of the important things, which are income taxes in retirement. And what I'm going to do is I'm going to switch back and forth between some bullet points. I've been known to talk a little bit fast, and so this way we'll make sure that the points that I'm talking about are also covered in text. Okay, so let's switch over. We're going to get into income taxes in retirement and some of the things that you need to know, and we'll go through this as methodically as we can, even though it might have to do with income taxes. So let's outline first the timeline of opportunities that I've been talking about since the beginning of this, about 5 or 6 weeks ago when this whole mess first started. And I want to kind of outline a couple things for you as we go along. When this first happened up here in this disbelief area, this is back, in February, which you can see down here in February. And back at that point in time is really when we saw a lot of the market as the market dropped and as we started to see things go down. We are somewhere right around here at this level that I have talked about in the past. Again, we're going to see a lot of this volatility. Even though I'm showing a straight line, there'll still be volatility as I believe employment comes back, and back here in the market we'll see volatility too. Now, what I'm going to talk about mainly today is the issue of income taxes. So let's talk about income taxes. So right here, between the end of March or middle of March, there was $6 trillion of federal aid that has been released. Well, question is, who's going to pay for that? Well, we know that the recovery is not going to happen until sometime towards the end of the year to even the beginning of next year. Now, originally, I put this timeline in that I thought taxes were going to spike here at the beginning of 2020 or 2021. I now think that some of those tax changes are going to be somewhere in this range between the middle of 2021 and towards 2022, okay? And the reason is, we saw a slow adoption to the people that were supposed to be sheltering at home. They didn't follow what they were supposed to follow. And so we had a little bit longer extension of what we feel is going to be this containment of the virus. However, the real key is when we look at the amount of taxes that are going to be due, well, how are they going to cover those? Well, number one, we'll probably cover those in payroll taxes. Number two is they're probably going to cover those through the estate tax, which we plan on coming back now since this whole mess has happened. And three is definitely an increase in income tax. Now that could come in just from a pure rate increase, or it could come in because of a capital gains tax. So it's important to see or look ahead to understand what can we do right now to prevent more devastation. I mean, the last thing we want to do is be caught blindsided when the taxes come out and you're going to owe some huge percentage larger than what you thought you were going to owe. So let's start with the first thing with taxes. The new tax deadline is July 15th of this year. Now, why I say that that's important, and let me flip back to that. I don't know what I just did there. Too fast on my computer. The tax deadline is July 15th. However, everybody needs to be aware that if in fact you did have a tax due, then you will not owe that tax until July 15th. Now, you could file your taxes now and you could pay your taxes now if you have that due, but it's not a necessity. Now, in July of 2020, you'll find that that's the deadline that you have to file this year's tax returns. If you want to go and extend your tax return, meaning that you want to push it into an extension period, then you're going to have to file an extension. That extension is not going to be due until July 15th, July 15th. So there's no extension needed on April 15th. If you want to extend into October 15th, then you would file your extension on July 15th. Now, let's talk about file. Should we be filing right now or should we be delaying? Well, right now, your adjusted gross income is what is going to determine your stimulus check. So we've had a lot of calls from people going, well, I want to get my tax returns filed because I have bigger deductions for 2019. Those deductions are not going to make a difference on your AGI, especially if it's like a charitable deduction or an itemized deduction. So if you have not filed your tax returns yet, little typo there, and your AGI is considerably less than 2018, we can apply for the stimulus check now or by July 15th. You can wait on that because even if you were due a large refund, then file now. Or if you're not due a large refund, then wait until October 15th. Let's jump into retirement plan loans. Now, this is just a side note. A couple of weeks ago, when Congress approved the delay of the required minimum distribution, I think it was a congressman from South Dakota or Wyoming got on the news and said, I'm very proud of what we passed here. We delayed the RMDs for those people so that they wouldn't have to sell their stocks and take an early distribution and lose money. Well, I want to be clear. You don't have to sell stock to satisfy your RMD. You can move money from your IRA to your non-IRA, and that can be in the form of stock certificates, bond shares, physical bonds, or cash. There's no necessity to sell that investment. So when you move it to your non-IRA, whatever the value is what becomes taxable. So what I've been advocating since this whole mess started is satisfy your RMD for this year. And it could be more or less. There is actually, I shouldn't say that. There is no RMD to be satisfied. Now, as a side note, if you have already taken your RMD, there is no way to unwind it unless what you do is you're within the 60-day window. You can move the same shares back into your IRA that you might have moved out of your IRA to satisfy your RMD. If you sold the shares in your non-IRA, you can rebuy them and just move the same number of shares back into your IRA. That will undo your RMD for this year. However, I don't believe that is going to be the best avenue for most people. And the reason is, if we're facing a much larger tax burden, then it would make more sense to take that as much as you can this year and don't delay it. Now, why might you want to undo your RMD? Well, let's say that you had 100 shares of Disney and you moved 100 shares of Disney from your IRA to your non-IRA. And let's say at the time that you did that, it was $150 a share. Well, now it's about $105 a share. So what you could do, you could move it back into the IRA, and that would be your 60-day rollover. Then you could take it back out again at a much lower tax. Now, that's a lot of work. It's a lot of computation, but that is a possibility. Now, the retirement plan loans that they approved, let me go through those with you. You can now borrow up to $100,000 or 100% of your retirement plan, whichever is less. And you will still have up to 5 years to pay back the loan. However, I'm going to warn you that not all company retirement plans will allow you to do this. Some company retirement plans have the written language that you have to satisfy a hardship withdrawal first. So again, you should check with your company to make sure that this is a viable option for you. Now be sure to calculate this first. Now, this might be a good time to borrow that money out of your company-based plan and do what I advocate, which is look for investment property somewhere in October or November. Now, let's look at IRAs and retirement plan withdrawals. Right now, you could withdraw all of your IRA, 401k, and profit sharing plan, and you would avoid the 10% pre-59 penalty. So again, if you're under 59 and a half years old, there is a 10% penalty for withdrawing the funds. But under this CARE Act, due to the virus, you can avoid that 10% penalty. Now, if you're over 59 and a half, here's an upside, an advantage that really has nothing to do with the penalty in as much as a strategy where you can actually take up the entire amount out of your IRA, and you're going to have up to 3 years to either A, repay the funds, B, pay the tax, or C, convert to the IRA, or convert it to a Roth IRA. Now, let me be clear on this. When you take the money out, you don't get 3 years to pay the tax back. You still have to pay 1/3 each year. But what you can do is you can wait and still convert that back within the 3rd year. Now, obviously, what you would have to do if you decided to do that, and it might be an arbitrage situation, you would simply have to file an amended tax return and get back the money that you paid in tax to file that you paid in the 1/3, 1/3, 1/3. Now, I will be upfront with you. I'm holding off on this strategy until July. And the reason is that there's a lot of things that are being released right now from the IRS, and the IRS does not have the final regulations yet. Now, we do have up until September to withdraw all of the money from the IRAs. So at this point, I'm not advocating that anybody does that. Again, we have until July to make that decision, and I would much rather make that decision whether that's a good idea or not a good idea until after the IRS actually provides the actual regulations, and so I can see what we're dealing with. Right now, the proposal is that you have up to 3 years to convert it to a Roth, but we've seen, even with the Paycheck Protection Program, the PPP, they were changing stuff. The SBA and the federal government was changing things all the way up, actually after they released the first applications. We were filling applications out for some clients, and we went through 3 revisions. And again, this is probably going to be the same case. So we have an opportunity here that we're going to be looking at for our clients. But if you're not a client of our firm, then this is something you should seriously consider, because it's a way for you to arbitrage the money. And let me give you a couple examples of how you can do that. So here's the first example. Let's say, as an example, we take there we go. Okay, so let's say, as an example, we take an IRA, and what we do is we take it all out and we just stick it in a box. Now, what we can do with that, if we find a really good opportunity, we could buy real estate. And that real estate could actually provide a deduction that you can use against the tax that comes out. So you could offset, we've talked about offsetting, we could offset the tax that's coming out of the IRA. Now, the other thing that we could do is we stick it in this box, And then what we determine is the best option is a Roth conversion. And that might be a very viable option. Now, once we stick it in this box, we might determine all the way up to the third year, or so the regulations have right now, up to the third year, that we could actually just take this and push it back into the IRA, and then there would be no tax at all. Now, if we did that, what's happening is year one, you're paying a tax on 1/3 of the withdrawal. And then year two, you're taking 1/3. And then you wouldn't pay the tax on that 1/3 year in the third year. This is when you might decide that you might want to just roll it back. So if you performed this operation where you're rolling the funds back, that means that you have paid taxes on something that was not a taxable event. So all that would mean, as far as we read the regulations now, is we could amend that return and amend the year two return and get this tax that you paid back as a refund. Again, I'm not advocating that we do anything in this until July, but that is kind of the pathway that I'm seeing as an open door, an arbitrage on the 3-year offset that they're going to allow us. So when we figure out the Roth conversions, the first thing that I think you have to do is really understand how important it is to do the calculations. You might have heard that, I've advocated, please do not use these free online calculators that will supposedly determine if you should do a Roth conversion or not. Most of those Roth conversion calculators, and I got a good question that was emailed to me last week, and because what I was saying is, if you are using a calculator that is provided by a bank, by a brokerage company, what has been my experience is that they are not accurate. They do not do the calculations correctly. So what do I mean by that? It's not that their math is incorrect. They leave certain things out. So as an example, they might just ask, what tax bracket do you anticipate on being in? First, most people, put that in there incorrectly. Most people believe they're in a much higher tax bracket than they actually are, because there's two types of tax brackets. There is a marginal tax bracket, and then there's an effective tax bracket. The marginal tax bracket is what you read in a tax table. However, after you compute your gross income and then you take all your deductions, you end up with your net taxable income. That is what you then use on the tax table. So the effective tax is always going to be much lower than what your marginal bracket is. So a lot of times when you do these online Roth calculators, they are not correctly figuring out your effective bracket. A lot of times they're not going to figure out, well, what would happen if taxes went way up? I mean, the bottom line is, if we have a Roth, it's like having a house with a mortgage on it. Although we just have an account that has a tax lien. So let's say that I had a rental property, and let's say it's a $100,000 rental property, and I have a $40,000 mortgage on it. If the mortgage company came to me and said, if you give me $30,000 right now, we'll pay your mortgage off, I would do that in a second. Why? That's a 10% rate of return. I mean, I'm essentially saving $10,000 on that mortgage divided into the value of the property. I just saved or made 10%. That's not much different than a Roth. See, people view the tax that you pay on a Roth as a takeaway. That's not how we view it. Our planners are experts at figuring out what the net increase rate of return is by paying a lower tax. So when our planners are figuring out whether you should do a Roth conversion or not, they're not using some little rinky-dink online calculator. They're actually putting it into a very high-powered machine that figures out your actual tax brackets after your deductions as if it's doing the actual tax return. So when you hear me say calculate, I should preface that by saying calculate correctly and accurately. Just because we use a free online calculator doesn't mean it's going to be accurate. Now, this email that I got sent me to, they had found this online calculator. And again, it was not related to a bank or a brokerage company, which is good because a lot of times I find those ones are, let's say, sleight of hand. They're even further off than everything else. However, this was a free online calculator, and when I started doing the calculations again, it wasn't up to par. So generally, if you're going to have a calculator that has that kind of power, you're going to have to pay for that because that is not easy programming. So again, you got to be careful with the calculations that you use. So calculate first. Second, use the share selection method. So what is the share selection method? So if I have, as an example, I have a Roth, I have an IRA. If in that IRA, I have, say, 100 shares of Disney, and Disney about a month and a half ago was at $150 a share, and now they're down to about $105 a share. If my RMD was $10,000, I could satisfy that RMD by just moving the shares. I don't have to sell them. If I am going to do a Roth conversion, I can move those 100 shares into the Roth and it satisfies the Roth. And why would I want to do that? This thing is down 30%, right? So why wouldn't I want to move those shares at a 30% discount into the Roth? When those shares go back to $150 a share, I could cash that Roth out and it's 100% tax-free. Now, the presumption is that you also have had that Roth for at least 5 years. So this is one of the big confusions. People will incorrectly they misunderstand the Roth. Let me clear it up for you. And if you really can't get to sleep one night, here's what you can do. Go to irs.gov. Download Publication 590. It's some very light reading. I'm kidding. But it'll save on sleeping pills. If you have insomnia, it's a great medicine to fall asleep. However, many people misunderstand a Roth and they think I have to leave the investment in the Roth for 5 years. That's not how it works. Your 5-year waiting period is the 5 years from the date you have opened and funded the Roth. There's no IRS requirement on how much you need to fund it. So normally what we advocate to our clients is, let's just open a Roth. We may not need it. Let's throw $100 in. And that starts the 5-year clock ticking. Now, I'll tell you a great story that happened to me back in Sarasota. And I can't mention any names, but this is just such a wonderful story. I have to share it with you. So I was practicing in Sarasota, and I had a guy that came in the office, and he was a MD, but he was also a research physician. And he and 2 friends were working on this chemical that would be used in orange groves, and the orange grove to kill a type of fungus that kills orange groves. So he came in and I said, well, what do you think the potential for this thing is? And he said, this thing could be off the wall. I mean, I just don't know. And so he had shares in his company, and so did his other 2 partners. So what we did is we facilitated a Roth conversion. And then what we did is we set up a separate entity to buy those shares. We relieved control so that we met Section 672. So here's what ended up happening. He paid the tax. It was on about a $250,000 rollover. Now, this was back in the day where I think this was 96 or 98, and we had 2 or 3 or 4 years to spread the tax out. So it was a wonderful thing. He and his 2 partners ended up selling that company to a huge global conglomerate chemical company. His single take was $25 million. And the beauty of it was 100% in the Roth, which meant there was zero tax. So again, we want to think ahead on events that might happen. And you may or may not use a Roth, but it doesn't hurt you. Now, here's the key. You have to open it with a good custodian. And while I'm not making this as a recommendation, the ones that I've felt comfortable with are TD Ameritrade, Schwab, E-Trade, and Interactive Brokers. One of the reasons is all 4 of those companies will open up a Roth for you 100% free. There's no annual fee. There's no minimums. I mean, you go to some of these brokerage companies or some of these banks and you open up a Roth and they want to charge you $50 to $100 a year unless you keep a certain account balance. So that would be what I would suggest is opening up the Roth, throwing $100 in it. You may not use it right now. However, at the time that you need it, you want as many of those 5 years to elapse as possible. So the Roth conversion is a great idea, especially when the shares are down. And what you want to do is you want to use the shares that have fallen the most. That allows you to move out the highest number of shares at the largest discount. All right, let's talk about something that I talked about just for a second yesterday. I didn't spend much time on it, and I got a bunch of email questions on this. So I'll answer this today. Payroll tax deferral. So payroll tax deferral under the CARE Act allows a deduction of 50% of employer-paid payroll tax. However, there are some exclusions on this. You may not if your gross revenue did not drop by 50%, if you applied for the PPP. And what it does do is it allows you to defer half of that payback until December 2021, then the remainder December 2022. However, my worry on this is the rules surrounding payroll tax. So the non-payment of payroll tax can be considered a criminal offense. And in addition, the government can pierce any corporate veil. What I'm saying is, let's say as an example, you have a company and you are having some rough time with that company. And you decide that you're not going to pay the payroll tax. Well, unfortunately, this is considered a criminal offense. So some people have asked, well, can I just close the company down? And since it's a corporation, doesn't that relieve my liability? No, it does not. The liability for payroll tax extends past any closure of any entity. There is no entity that is safe. So my worry with businesses trying to avoid the payroll taxes is I can see what might be coming down the line in a year to 2 years from now. So let's say that a company says, I'm going to try to survive. So I'm going to defer my payroll tax or 50% of it, assuming they meet the other requirements. And a year from now, they just don't make it. Because you've heard me talk before, there is going to be a massive paradigm shift. It is going to be the biggest one, I believe, in the history of our country, because we've never seen anything like this. Some research on the 1918 Spanish flu virus that killed between 17 million and 50 million in 1918 and 1919. We saw that there was a paradigm shift, but we didn't have the ability for farmers to change the way that they worked. If you're going to go out and till the field, and when the pandemic was over, you had to go back out and, hook up the horse. However, today, what many companies are finding and what many consumers are finding is that they can order at home. They can stay at home and watch TV. So we have a movie industry. We have a mall industry. We have commercial and retail industry. We have office buildings that I see are going to be a big change. So again, as these things change, there's going to be certain businesses and industries, no matter if the economy comes back at 110%, these industries are not going to survive. Remember Betamax? You remember video, VHS? Do you remember 8-tracks? We evolve, and I think that this pandemic is going to create the biggest evolution ever. Now, what does that mean if you are that kind of business? If you're that kind of business, you might go out of business in a year or two. So my big question, because there's no regulations that if your company closes, that the government is going to forgive the payroll tax. By all laws, the payroll tax is still considered a payment by the business owners. And if not, it's a criminal offense and they can go after you personally, your personal home, everything that you've got. So this one I'm holding off on. I'm not real comfortable with telling anybody to go get this. Now the PPP, completely comfortable with that. The $10,000 EIDL, completely comfortable with that. I'm even comfortable with the up to $2 million in EIDL if you have the ability to grow with it. But the payroll tax, that's a little bit more dangerous. So I'm holding off on that one for now. The new Secure Act. Well, RMDs don't start until age 72 now. In 2020, you can waive your RMDs. However, we also know that there's a tax time bomb for beneficiaries. So no more RMDs for children. They must take out 100% by the 10th year. So what is my position on this? Well, here's my position on this big change. First, I'm not going to suggest anybody delay their RMDs. I think you're just asking for a giant tax bomb. If there's $6 trillion in debt, they're going to get that repaid. And who do you think is going to repay it? Do you think that they're going to go after the poor or lower middle class? Of course not. They're going to go to the easiest target that they can identify and that they can tax. And that is going to be for any of you that were extra hard workers. You didn't splurge, you saved, you invested, and now you've built yourself this nest egg. That's easily identifiable by the IRS. So I would not suggest deferring your RMDs until say, well, my taxes might go down, and you might have a unique situation where that might be true. However, I think that would be very, very unique. The 2020, again, I would not suggest waiving your RMDs. Do a Roth conversion instead. However, the tax bomb for beneficiaries is still a problem. If you attended the webinar that I did on the emergency actions on your trust, you know that I had created a petition. We sent it to Congress. We sent it to the White House, asking them to make a provisional change within the Secure Act. Because the current Secure Act leaves a hole in the ability to protect our assets to our children or grandchildren without it becoming a tax bomb. Now, where we stand right now is we are currently revising the language in all of our revocable trusts and in our IRA standalone trusts. And I'll give you a real quick update. We created the strategy on how we could avoid this tax. However, it's gone out to a number of different legal entities that we work with so that they can research that trust language so that we can make sure that under the current Secure Act, if you pass away, we have a way that we can avoid the restriction on a beneficiary getting to the IRA, as well as avoiding the giant tax bomb. So we're probably about halfway through that process, because again, we've sent it out to outside legal firms and lawyers, and we're looking for multiple opinions on our strategy to make sure that we don't create more holes than what the Secure Act already has. And we'll probably anticipate another 2 to 3 weeks until we get that language solidified. Once we have that language solidified, then we have to figure out how are we going to redo everything, and how are we going to figure out how to make sure that all of those people that even aren't our clients are aware of the problems that it will exist within every single revocable living trust and within every single IRA standalone trust. So again, that's on hold for now until we get all of our legal opinions back. So again, the tax bomb is something that we are working on. We'll get back to all our clients, but stay tuned for what's coming up. Let's talk about the refinances, because the refinances are things that I have talked about that it's a good idea. For the first 3 or 4 weeks of this virus, I put everything on hold. I told everybody, please do not refinance. Just get your mortgage application in. And then about 2 weeks ago, I gave the green light to say, go and refinance, get it done. So here's what I want to make sure you're aware of. There is a mortgage constraint. And what is a mortgage constraint? Well, a mortgage constraint means that you can go refinance, but you have to be aware of how much you can actually deduct. So let me give you an example. Let's say that you're sitting on a $500,000 house, and you originally paid $250,000 for it. And we're going to make the presumption that you have not made any improvements to the house. So based upon $250,000 house, the max you can borrow and still get a tax deduction on it is going to be $250,000. Now, that might not make any difference to you at all. It might be about lowering the interest rate. But I got some emails from people that said, well, this is great. I'll refinance my $900,000 mortgage and I'll get a better tax deduction. So I wanted to make sure everybody clearly understood there are limitations to this. So the number one limitation is if you take the mortgage after 2017, you're going to be limited to a maximum mortgage that you can deduct of $750,000. Now, the good news is it now includes first mortgages, second mortgages, home equity loans, and HELOCs, home equity lines of credit. As long as the total, and it's also for a first and a second residence. Now, the constraint is still you can only deduct up to the purchase price plus the improvements of that house. Now, if you bought a $500,000 house and you have a $250,000 mortgage and you want to take $50,000 out to buy a vacation house, you can refinance that $250,000 up to $300,000. Take the extra $50,000 out, and you can still deduct everything on that $300,000 because, again, it's less than what you paid for and plus improvements on the primary residence or on the house, primary or secondary. So I'm in favor of refinancing. I'm in favor of getting ready for a big real estate crash. As a matter of fact, if you read, I've been talking about big data. I've been talking about how stock investment firms use big data, and they actually will use it to scan social media, Twitch, Instagram, Facebook, all these different mediums, and they'll take the sentences and the posts that people are making, and they put that into artificial intelligence to figure out what are people feeling, what are their trends. What are they going to do socially? This morning, there was a release from a large real estate investment company who's using this big data. And I thought it was interesting because they actually showed some of the posts that they aggregated. And apparently the millennials are excited because they're hoping that the real estate crashes by 50%, because as many have stated in these posts, this will be the first time that they've actually been able to afford a house. So where I talked about this very short-term bounce in the real estate market, there's two factors that will push that bounce. One is millennials that couldn't afford a house will now jump in. Secondly is the institutions will jump in. So this is not going to be a long window. So again, getting back to the point of what should you be doing with a refinance? First, do the calculations. Don't just take it on Ken Himmler's word. Go out and just refinance. You have to do the hard work. Do the math. If you don't know how to do that and do the calculations, call our office. If you're a client of ours, our financial planners that are working with you will do those calculations for you. They'll figure it out. They'll even figure out what the net is after the tax exclusion or tax deductions. If you're not a client of ours, you got to find somebody that doesn't have the intent to sell you a mortgage. You don't go to a mortgage company and ask them to compute if you should refinance or not. Well, of course they're going to. It's like the old joke about insurance agents. If you ask any insurance agent if you need insurance, what will their answer be every time? Of course you need more insurance. Okay, so let's be careful out there as far as the refinancing. All right, with that in mind, let me just jump over here and I'm going to follow up. If you haven't noticed, we've stopped doing the webinars, and the main reason is the webinars had a bit of a glitchy issue. So you can join in on any of our events, and if you want to know what the event schedule is, just go to hhrdm.com/events. Again, it's hhrdm.com/events. Or you can just look us up on YouTube or on Facebook. Just do a search by H&H Retirement on YouTube or H&H Retirement on Facebook, and you will find our information there. And with that in mind, I'm going to just put a message out. Listen, the economic mapping that I put together about 6 weeks ago, I know a lot of people were out there that were nervous because this stock market tanked by 30%. And I originally stated right at the beginning, this is not an economic event. This is a health event. And the virus will dictate the economy. The economy, in my opinion, is going to roar back to even better than where we were before it happened. I know unemployment is going to go through the roof, but this is a short-term unemployment. If you're reading things where they say that unemployment is going to take a long time to assimilate, it will. It'll take at least a year. However, some of the businesses that will close, that you read a lot of this material about, well, these people won't find another job. If you want to work, you'll find a new job. You could just take a look at what's happening right now. Walmart is hiring 75,000 new people. Amazon, 50,000 new people. It's not that we don't have a strong economy. It's that we're going to have a redistribution of work, of commerce, and those of you that can sit back and understand that trend, you're going to be sitting in a better place than before the virus. I did an entire broadcast on why there were more millionaires made in the 1929 crash per capita than in any other time in history. It's because those people that sat back, that looked at it, could take advantage of it. Now, with that in mind, I do recognize this just horrific. Little kids are left without parents, and parents are passing away, and families, you can't even say goodbye to them. And so one of the things I tell everybody is, while this horrible tragedy is going on, please, please stay at home, do the right thing, and lastly, make sure that your estate planning documents are updated. Make sure that your current trust is fully funded. Make sure that your healthcare power of attorneys are updated. Make sure that your financial power of attorneys are updated. Because what I predict is that the probate system that normally takes 12 to 18 months, when this is over, it's going to be jammed up for 3 to 4 years. The normal probate system that takes 3 to 7% of a client's estate assets will probably be in the 10 to 15% range. So please make sure that you take care of the financial protection of your family as well as the health protection of your family. And with that, I'm signing off. Have a great night.